Thank you for coming to this YouTube site of mine. I want to talk to you today about some very exciting possibilities to send your child or grandchild to college for free using real estate in Great Falls. But before I do, I want to tell you a little bit about me, because right now you see a blank slate in front of you. There's nothing there other than coloration. And that's probably what you're thinking of for me. You don't know me. You don't know anything about me. Why should you listen to me? What have I got to say that might benefit you? I've been a real estate broker in Great Falls since 1978, 34 years ago. During that time, we've been involved with all sorts of real estate, rental properties, commercial properties, regular house sales, regular house listings. So what I want to show you, I've done. We've lived through the real estate markets. We've gone through the ups and the downs. And I think what we have here for you works quite well. So let's talk about sending your child or grandchild to college for free using real estate in Great Falls. I'm going to use the two universities in Montana, Bozeman and Missoula, as examples. According to their websites, it will cost you roughly $16,000 to attend an academic year in Bozeman and $14,000 in Missoula. Instead of $14,000 or $16,000, I'm going to suggest that you aim a little higher. Let's consider $20,000 per year. Part of the reason is the cost of college does not necessarily stay pace with the rate of inflation. It tends to be more. So if we budget for $20,000 but only need $16,000, that's good. But if we need $20,000 per year but we've only budgeted for $16,000, that's not good. So let's aim for the higher figure and hope we don't need it. It's better to have it and not need it than need it and not have it. The second point I want to make is it used to take 4 years to go to college and get a degree. Lately, it's been taking more. In this example, you would aim for $100,000 as your goal so that that child or grandchild can go to college for free. I'm going to suggest a little higher figure of $120,000. These figures assume your child wants to go to Bozeman or Missoula or another in-state college. That may not be the case. They may want to go to an out-of-state college or an Ivy League college. So let's aim for something that will help us get closer to those figures if we need them. Historically, the rate of inflation has been right around 3%. That's for the last 25-30 years. It has stayed in the neighborhood of 3%. It's gone up, it's gone down, but it's averaged somewhere in that range. So let's assume an average of 3% for the rate of inflation. What does $120,000 have to be worth in 15 years, allowing for a rate of inflation of 3%? The answer is $187,000. We need $187,000 in our pocket after taxes in order to give our child or grandchild the education we want them to. Let's assume you have about $20,000 to invest. What can you do with $20,000? Well, we have several options. Let's consider the stock market. We can put our $20,000 into the stock market. If you talk to a stockbroker, he or she will tell you that you can reasonably expect a 10% compounded annual return on your invested dollar. The last 15 years it's been 8%, but that's included a major and a minor recession. So let's assume 10%. We're going to put it in for 15 years. At the end of 15 years, our $20,000 will have grown to $59,178 after allowing for 25% tax rate. But we need more than $59,000. We need $187,000. So what do we need to do in order to get $187,000? How much do we need to invest? The answer is $64,000. $64,000 invested at 10% compounded annually in the stock market over 15 years will yield $187,000 after taxes. What are taxes? Well, we don't know what they will be in 15 years. Today, capital gains rate is 20% federal, and let's allow for 5% for state. That totals about 25%. Here is a website that I use to calculate a lot of these figures you're going to see in this presentation. Feel free to visit it, play with other numbers, and do whatever you want to with the numbers that you feel comfortable with. So let's put the $64,000 in. We're going to get that 10% annually compounded rate for 15 years. We're going to end up with $187,000, which really means we're going to gross $228,000. That's what we need to expect to get, $228,000 to allow us $187,000 at the end of the day. We can consider annuities. An annuity is where you pay a constant amount into an account, assuming an annual return for a set time frame. The question is, how much do you need to put in per year, allowing for a 10% annual compounded return on investment for 15 years to end up with $187,000 after taxes? The answer is $6,000 per year, which over 15 years is $90,000. That is for a 10% annuity return. Allowing for a 5% annuity, the dollar is $8,500 per year, or over the 15 years, $127,500. We could do a lump sum annuity. This is exactly the same as with the stock market. With the lump sum annuity, we will put in $64,000. It will compound at 10% annually over 15 years, ending up with $187,000 after taxes. Or at 5%, we're going to put $110,000 in. Now, my attorney has asked me to disclose to you, I'm not trying to get you to buy any of these products. Stocks, bonds, annuities, or any other security. That takes a special license. I don't have it, and I don't want it. I'm a real estate broker. I help you buy and sell real estate, and that's the reason for this presentation. As long as we're talking about that, what about real estate? Let's assume you have $24,000 to invest. That will allow you to purchase a $120,000 rental property. Let's assume we can get a loan for 30 years at 5%, which is what you should be able to get, and as of the time I'm recording this, that is typical for the marketplace. With real estate, we're going to purchase this $120,000 house with 20% down, which is $24,000. We're going to assume a 10% annual increase in value. We're going to own it for 15 years, at the end of which we will need $187,000. So if we do this, we buy this $120,000 house, and it increases in value at 10% per year. At the end of 15 years, it will be worth $501,000. We will have taken a $120,000 investment and converted it to $500,000. But more importantly, considering it should be paid off, we have taken $24,000 of actual cash and converted it into $500,000. Not a bad return on your investment. Now, I don't expect real estate will increase in value 10% per year for 15 years. It might on any given year, but over the 15 years, it's very unlikely that it will. So let's assume a more conservative 5% return. It grows 5% per year, compounded annually. We're going to put it in for 15 years. Again, we still need $187,000. After 15 years, this $120,000 purchase or $24,000 investment is now worth $249,000. We have taken $24,000 and converted it to $249,000 over 15 years. That is also not a really bad investment. If you will look, we need $187,000 after taxes. We have about $65,000 of excess money that we can access for other reasons, or we could just leave it in. But that's a tremendous return on your invested dollar. Now, is that realistic? Can we expect a 5 or a 10% return? 15 years ago, the median price for housing in Great Falls was about $80,000. Today, that figure is about $166,000. That essentially is a doubling of value. So let's assume housing will double in value over the next 15 years as well. I have another attorney disclosure that I need to go over, and that concerns the value of property. Nothing here is intended to guarantee any return on investments. We cannot guarantee future profits on any real estate investment. What you see here is just math. Let's talk about loan payments. When you buy a piece of property, the example that I'm using shows a 20% down payment and 80% loan. There are 3 ways you can get a typical loan. The first is a straight 30-year amortization, in this example at 5%. In that loan, your principal and interest payment will be $536.82. Allowing for taxes and insurance of $150, your total payment is just under $700. So for purposes of comparison, let's use the figure $700 as the house payment for a 30-year loan at 5%. You can do a 15-year level payment loan, 15-year amortization. Your loan payment will be $790.79. Adding taxes and insurance, your total payment will be about $940. For comparison purposes, let's use $1,000 as your loan payment. The method I recommend is a 30-year loan paid in 15 years. And I'll show you how that works in the next slide. Your house payment will be $668.82 for the principal and interest, allowing for $150 for taxes and insurance. You're at $810. Allow $825 for purposes of comparison. This is how it's structured. In January, you are going to pay the normal loan payment of $536.82. In addition, in January, you will pay the next month's principal interest portion, which is $120.65. And those will be paid in January. Then come February, you will pay your normal loan payment of $536.82, and you will add to it the next month's principal payment, in this example of $121.66. Those will be paid in February. If you do this consistently, you will take this 30-year loan and pay it off in 15 years. Each month, your payment will go up slightly. In this example, $1.01 between the February and the April principal balance amounts. So to summarize, looking at those 3 options, if you have a rental house which rents for $1,000 a month, which is realistic in this market, on a $120,000 purchase, with a 30-year loan, you will have a $300 per month net income. On a 15-year loan, you will pretty much break even. And on a 30-year loan paid in 15 years, you will have about a $175 per month net income. The best advice that I can give you when you are structuring your loan, structure the financing to benefit you, not the bank. What this really means is this. You are going to purchase a piece of property. The tenants are going to occupy this property. At the end of 15 years, you are going to have an asset that will help your child or grandchild go to college. The tenants will be paying for your child or grandchild to go to college. Other people are paying for your child to go to college. That's pretty decent. You are going to invest $24,000 into this program, which means you're taking about 1 year's worth of college expense and converting it into 5 years' worth and then some. Let's compare real estate with the other investment opportunities. With real estate, using the example I have given you, a $120,000 house, $24,000 down, assuming a 10% return on investment after taxes, will yield $501,000. That happens to be before taxes, but there are ways to get around those taxes with that property. So for comparison purposes, we will assume that it is after taxes. $24,000 at 10% converts to $501,000. In the stock market and the lump sum annuity, it is $64,000, which will yield after taxes $187,000, or with an annual annuity, $90,000, which is $6,000 per month. If you have invested in real estate before, you know that there are 4 benefits to owning rental real estate. The first one is it should go up in value. The second one, the government allows you to pretend that it goes down in value. The third one is cash flow. And the fourth one, over time you will pay your loan down, and that decrease in your loan balance is an actual return on your investment. Let's analyze the 4 benefits of owning rental real estate as it relates to the kind of property we will be buying. That is not a $120,000 house in Great Falls, but it serves its purpose as an example. Let's assume rental real estate goes up roughly 5% per year. We get to depreciate it over 30-ish years, and we're going to allocate $100,000 to the building and $20,000 to the land. The $100,000 is depreciable, the other is not. As far as cash flow goes, let's use the example that I gave earlier. We have a house that will rent for $1,000 a month. Our loan payment will be around $825 a month. That leaves $175 per month for cash flow. As far as paying down the loan, structuring it the way I suggested, we will use the example of the amortization schedule that I showed you. So for a $120,000 purchase, we're going to have a $6,000 increase in value, a $3,000 decrease in value, a $2,100 per year cash flow, and a decrease in the loan balance of around $3,000. That totals $14,100 divided by your $24,000 investment, and you're not dividing it by the value of the purchase, which is $120,000. You're dividing it by your actual out-of-pocket investment amount. $14,100 divided by $24,000 is 58.8% in the first year. Couple disclaimers I need to make. I am not an attorney. I am not an accountant. I do have a bachelor's degree in accounting, so I understand what I'm doing. I also am an investor and have done this type of analysis many, many times. So I have a pretty good idea of how it's done. I just don't have the title of being an accountant. And I'm not a financial planner. So how do you get the money out after you've purchased it and owned it for 15 years? There are two very easy ways. There are others, but these are the two that I'm going to promote to you. First, you sell it. When you do, you've got capital gains taxes and any other number of taxes that you'll have to realize. The second, you refinance it. If you refinance it, money is taken out tax-free, at least for now, and under current tax law. We don't know what it'll be in 15 years, but today, if you were to refinance it, that money is tax-free. A common question is, why should I buy a house if I'm only going to live here for 1, 2, or 3 years? An example would be you're in the military, you're going to be transferred out, you're in a job in which you expect to be transferred out, things like that. And the answer is, it doesn't matter where you buy the house, it matters that you buy the house. $187,000 is the same whether it's in Great Falls, Montana, or Orlando, Florida. Again, what matters is that you do it, even if you'll only be here for a short time. We have people who can manage your property once you leave. If you buy and live in it as an owner-occupant, it is easier, it is lower down payment. It's actually 0% for a VA, about $100, and the interest rates are a little lower. So if you have a child in that age 5 years or younger, and you are living in your house, once you move, buy another house for the next child, and so on and so on. The concept works the same way wherever you are. Once you move out, it becomes an investment. I want to let you know that this concept works for all prices of housing. I have put this together with a $100,000 house. I have put it together with a $135,000 house. And I've put it together with a $170,000 house. Each one will rent for a different amount. The $170,000 house happened to rent for $1,500 a month. The $135,000 was $1,000 a month. And the $100,000 house was about $950 a month. Each price range will work. So what I want to stress to you is this. The program works regardless of the price, to a certain degree. If you got a $500,000 house, that probably wouldn't work. But that's not what we're looking at. We are looking at a reasonably priced property that will rent reasonably quickly in a reasonable market. This works for all prices of housing that you would want to look at. When you own rental real estate, I can guarantee you that over time, you will have a bad tenant. You will also have good tenants, hopefully more good than bad. You will have maintenance and repairs, and you will have vacancy. All I can say is keep the faith, stay the course. Over the time, it will work out for you. There are 3 objections that I typically hear. The first one is, I wouldn't want to live in a $100,000 house. Well, don't. But I guarantee you that a tenant will be thrilled if it's a good quality house that they can afford. You're not buying it to live in. You are buying it as an investment property to help somebody else live in it. The second comment I hear, primarily from older people such as I, people who have lived in the market for several years and have seen it change, I could have bought that house for X amount of dollars 20 years ago. When I first started in real estate, houses in the Riverview area were $45,000. Today those houses are $165,000. What do you think they will be in 15 years when your kids or grandkids go to college? And then finally, I hear this from many people who are looking at an investment. If it's such a good deal, why don't you do it? I have done it. We own 12 houses. I have 2 children. I don't have enough children for houses, or I have too many houses for the children. Because I have done it, I know it works. Some of you may be thinking to yourself, I don't have the money to do this. It's a great program, but I don't have the 20% down payment. Well, I'm here to tell you that yes, you probably do. You just don't realize it. You don't know other sources of funding other than what you've been taught. Cash in your pocket, cash in the checking account, things like that. There are many, many other options out there. Let me show you how to structure this so that it can work for you and your child or grandchild. Some of you still may have hesitation. You may be feeling a little bit nervous. Am I going to get into this and not like it? What about the house? Is it going to be something I'm satisfied with? The program, does it work? Is it going to work? I have a guarantee for you that if you don't like this property, or it isn't working for you, within the first 12 months, I will buy it back. It is a guarantee that you will be satisfied, because if you are not satisfied, I will buy the property back from you within the first 12 months. I would be very surprised if you could find another realtor in Great Falls or anywhere who will offer this option for you. To my knowledge, I am the only realtor who will offer this. Now, obviously, there are going to be some details to be worked out. For example, what kind of terms would that buyback be? I would be more than happy to discuss that with you if this is something that interests you. Now, can you think of any reason not to try this program? So, are you ready to do this? You need someone who understands why you are investing to make it work. And any guesses who that might be? This is my name. This is my real estate office. This is my office phone number. And this is my cell number. Let me explain how I work. I will locate properties for you that can work with this program. We just need to decide what price range, style of house, etc. you're interested in. But we need to limit it to about 3 houses for your first looks. If you get more than 3 houses, they will start running together in your mind. Plus, you're not looking for that perfect house to live in. You're looking for a decent house to rent out, so that a tenant will have a decent house to occupy and live in. So we need to limit it to about 3 houses the first time. Once we limit what those houses are, I will arrange for us to look at those houses. You will decide which one you like best. I will explain to you how that particular property will work for you. There is a flip side to this, and that's how you work. I need you to decide how ready you are to buy and to utilize this program. First kind, I want to do this. I am ready to arrange for my kids or my grandkids to go to college as inexpensively as possible. That's a good position to be in because it allows you to take advantage of the marketplace the way it is now, before the interest rates go up, before the prices go up. Get into it now and get moving. The other option you may be looking at is, this is a really neat idea. I want to pursue it, but I need to talk to somebody else, my bank, my spouse, somebody, my parents, my kids, somebody. The third one, let's face it, some of you are just here to see what I'm selling. What are you trying to sell? Actually, I'm not trying to sell anything. I'm showing you a great investment opportunity that can work for you if you want it to. But if you don't do anything, it won't work for you. And then, of course, the fourth kind, I have a realtor. Even though he or she doesn't know what the heck I'm talking about, I will have him or her help me and take my chances. That's okay, because the second time you'll probably buy from me. There are certain state-required forms that we need to go through. I'm going to go through them briefly here. I have another video that explains them in more detail, which I'll refer you to here shortly. There is a disclosure form for all real estate agents. We are all required to show you this definition form as early as possible in the transaction. It says there are 4 ways that real estate agents can behave in Montana. They can represent the buyer, the seller, both, or neither. I need to represent you as much as possible. I am a buyer's agent whenever possible. That's how I am most comfortable. Please review the other YouTube video that I have entitled "Don't Tell Me That" for a better explanation as to why this is an important issue. So, it's time to take action. You can do something, or you can do nothing. Nothing will get done unless you do something. I can't help you unless you let me. Please do one of the following. Call or text me. This is my office number. This is my cell number. I can receive texts on the cell number. Send me an email. This is my email address, goodover@centric.net. If you're interested in this concept, put in the email title, College Idea. If you want to give me feedback or ask questions, put in the email title, Feedback or Questions. So, do something. Again, this is my name, my office phone number, my cell phone number, my email address, and my picture. Please get a hold of me and let me help you structure something so that your child or your grandchild can go to college in 15 years effectively for free. Thank you for watching this video. I look forward to helping you.